welcome back to JPX Energy Market Weekly Updates. Crude price benchmark remained range-bound with high volatility last week. Supported by continued tension along the Ukrainian border, dated Brent rose about $100 for the first time since 2014, and cash Dubai reached above $92 per barrel. JPX Dubai first-line contract was also hovering around new high levels, according to Plus Assessment and JPX trading data. Crude oil futures were once sharply lower during the second half of last trading week as Iranian nuclear talks were nearing a deal, while U.S. crude oil stocks unexpectedly rose last week. Volatility in markets set to persist as market movements lean towards being more news-driven, as we have witnessed last week. The headlines can swing sentiments wildly under the background of high oil price and low oil inventory. The tension between Russia and Ukraine has not seen signs of mitigation for the time being. On Saturday, Ukraine military said 2 soldiers were killed and 4 wounded in shelling by pro-Russia separatists in East Ukraine, and President Putin has launched exercises by Russia's missile forces. A flare-up of violence this week has sparked fears that could be the trigger for further military action. And the potential enforcement of additional financial restrictions on Russia brings the flows of the world's second-largest oil and gas exporter into the spotlight. Russia's Europe's top oil supplier. Of the 11 million barrels per day Russia oil produced last year, Europe imports some 4 million barrels per day. A major escalation resulting in swing sanctions on Russia may threaten oil and gas flows further afield to China, Japan, and South Korea. So, considering Europe's heavy reliance on Russia's oil and gas, current high prices, and the scale of impact on energy markets, the potential for sanctions on Russia's oil export looks remote. European country leaders have said previously, any sanctions may be imposed on Russia by the European Union should not include energy imports. Ongoing talks between Iran and the world powers to revive the 2015 nuclear agreement reignite the hopes of more crude supply from the Middle Eastern country, winning on prices, especially on the regional benchmark Dubai. Crude futures fell sharply following assessments after Iran's top negotiators said via Twitter that the United States and Iran were nearing agreement in ongoing nuclear talks. And the United States Department spokesperson said the sides were in the very final stages of negotiations. Iran is to believe have made steady progress in preparing its oil network, enabling to ramp up relatively quickly once sanctions are ceased. According to IEA's report, by the end of this year, crude production could rise towards a sustainable capacity of 3.8 million barrels per day, up roughly 1.3 million barrels per day from current levels. Iran also has about 80 million barrels of crude and condensate stored on oil tankers, or what we call the floating storage, and will move to clear that overhang as quickly as possible. According to Reuters' report, the draft text agreement stipulates a sequence of steps to be implemented once it's been approved by the remaining parties to a deal, starting with a phase including Iran's suspending enrichment about 5% purity. Consequently, there is little chance for Iranian oil returning to the market in the immediate future to seize current supply tightness. Reflecting the tightness in oil supplies, the 6-month backwardation in Brent and Dubai hit its widest record on Wednesday. Backwardations in market structure occurring when contracts for near-term delivery are priced higher than those for later month. That could also be explained as a premium the market participant willing to pay when the market supply is tight. ExxonMobil and Chevron have just announced plans to increase output from top U.S. shale play by 25% and 10% respectively this year, and a growing number of firms said they plan to boost spending for a second year in a row in 2022 after cutting drilling and completion expenditures in the past 2 years. U.S. oil rigs rose by 4 this week to their highest level since April 2020, and so does the number of frac spreads. As U.S. shale responded to high prices, IEA have revised up its forecast for U.S. oil supply growth by 240,000 barrels per day for 2022 to 1.2 million barrels per day. It leads non-OPEC gains of 2 million barrels a day year on year, with Canada, Guyana, and Brazil also set to deliver solid growth. Downward price pressures will probably emerge in the middle of the year as growth in oil production outpaces slowing growth in global oil consumption. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.